So today we are going to talk about two use cases of moving averages, which are widely used in technical analysis. The first one is going to be golden cross and dead cross, and the second one will be to use moving averages in comparison to the stock prices. So let's first put things into perspective and define what is really meant by golden cross and dead cross. Golden cross happens when the short-term moving average crosses above a long-term moving average. A typical example is when 20 days moving average crosses above the 50 days moving average of a given stock. Golden cross is perceived as a bullish signal. Dead cross is the complete opposite of the golden cross and happens when the short-term moving average crosses below the long-term moving average. It is perceived as a bearish signal. Let's go through an example. In this chart, green line is representing the price trend of the stock. The white line is the 20 days and the yellow line is the 50 days moving averages. So this point in time, marked with the pink dotted line, is the point where we see the golden cross. The 20 days moving average crosses above the 50 days moving average and expectedly indicates a bullish signal. Let's assume that we buy the stock at this point in time. Until the end of the dotted pink line, 20 days moving average remains above its 50 days moving average. And at the point where the 20 days moving average goes below the 50 days moving average, the death cross happens. Since it's a bearish signal, let's assume that we sell the stock at this point in time. And this particular trade ends with roughly 4% profit. Well, now let's analyze the same graph with the other approach where we said that we are going to be using only one moving average in comparison to the stock price. Let's say that we buy the stock when the stock price crosses above its 20 days moving average and sell it when the price goes below its 20 days moving average. So this point, marked with the blue arrow, becomes our buy point. And we hold the stock as long as the price remains above its 20 days moving average. And we sell the stock whenever the price of the stock crosses below the 20 days moving average. And this approach gives us 22% profit in this particular example. So is one method better than the other? Or can we say that the second approach is always more profitable than the first one in all trading examples or use cases? So these are the buy and sell points of the first approach, which resulted with 4% profit. And this one is the second one, which resulted with the 22% profit. So let's forget about the profit figures for the moment. And as you can see, the second approach, the blue one, where we used only one moving average in comparison to the stock price, triggered both the buy and the sell signals earlier than the other approach, where we used the signals of golden cross and dead cross. And this happened to be an advantage in this case. One example is essentially never enough to generalize findings, but here are a few things that we could observe in our tests. The second approach, where we used one moving average only in comparison to the stock price, will likely trigger a lot more buy and sell signals compared to the second approach, where we used the signals of golden cross and death cross. Some of these signals can be good to increase the profit, but some of them may happen to be false positive signals as well, causing unnecessary buy and sell actions. So these approaches can give different results if, for example, other time periods are used for moving averages, such as 50 and 200 days moving averages instead of 20 and 50, or if you are in a bear or maybe bull market, or if the current market is more or maybe less volatile than usual. The market situation, the volatility of the market will be affecting the results of these two approaches. But there's one more thing that we should keep in mind for both methods. They use moving averages, and moving averages are lagging indicators. So, what are lagging indicators? They are basically the indicators that tell you what has happened in the past, such as previous days, weeks, or months, rather than showing how things will look like in the future. In trading, such indicators can be used to confirm the strength of a given trend that has been happening, which may help traders take better decisions in developing their trading strategies. So let's summarize our findings from this exercise. Relying on one single technical indicator is not a good practice. Traders tend to look at multiple indicators to confirm a trend reversal or continuation of a given trend. And secondly, if you are, for example, looking at daily moving averages or any other indicators, it can be wiser to follow the signals a few days before taking any action. If, for example, price of a given stock crosses above its moving average, you should probably wait and see whether the price remains above its moving average on the following days as well, so that you can avoid false positive signals as much as possible in your day-to-day trading. Apart from predictions and signals, Share Predictions mobile app offers strong tools to perform a proper technical analysis on any stock from the US stock markets. You can visualize several technical indicators on charts, check company financials, dividend histories, and latest company-specific financial news as well. Share Predictions is available in both Apple App Store and Google Play Store, and links to our application are available in the descriptions below.